Last week was the worst week for the stock market since October 2022. We have the likes of Nvidia down 9% just last week, Broadcom down 8%, a significant number of those in the semiconductors industry hit very, very hard. Now, when we take a look at the performance today, we are seeing a lot of them have started to rebound. Nvidia itself up nearly 3%, although there are some that have also struggled. We look at Intel, which has barely moved, AMD 0.31%, Avgo around 0.35%. Today's episode, we're going to take a look at 5 lesser-known semiconductor industries to outperform a lot of these big names that have been hit very, very hard. Now, there will be a lot of people who don't want to invest in individual types of companies, and there are ETFs for those kind of investors. One example, the very popular SMH, the Semiconductor ETF. It does have an expense ratio of 0.35%, currently is priced around $36, and for those that do prefer that, rather than looking at undervalued companies to make some massive returns, you can take a look at their holdings. They do have a lot of the big names that we talk about, Taiwan Semiconductor making up over 10%, as well as Broadcom, Nvidia, ASML, AMD, the likes of what we would say are very large semiconductor companies that are very well known. Today's episode, we are just going to look at 5 much lesser known with a lot more outperformance in them over the next few years. As well, if you do want to take a look at this ETF, the performance over the last few years has also been very positive as well. So if you have been holding over the last 10 years, or in fact over the last 3 years, you would see around a 21% increase year on year. Today's episode, we want to get a gain larger than that just in 1 year alone. So what we're going to do in today's episode, we're going to look at each individual semiconductor company. We're going to look at the historical performance of these smaller companies. We're also going to take a look at their dividend safety. Now, each one pays a dividend. We're going to run through the numbers. We're going to look at the financial metrics. And as always, with each one of these, we are going to run them through the valuation model, so we get to our own intrinsic value as well as our own acceptable buy price given our investor margin of safety. And we'll look towards Wall Street to see what they are forecasting percentage-wise as well as a price target just over the next 12 months. Now, before we do jump in and take an evaluation of each one of these semiconductors, we want to let you know we have released our latest free weekly article. Now, our latest article, we run through all the resources that we use in each episode. A lot of people always ask, what websites do we use? What are the resources? Well, if you do click on the pinned comment below, sign up, you get instant access and can read not just this article, but also all these other articles where we do explain a lot of information. So let's jump into the analysis. The first one is Monolithic Power System. It does currently trade at $598, and over the last 12 months, it is up around 26%. Now, we can currently see it is in the midpoint of the 52-week range, and we do also have 2 out of 3 buy ratings, a buy from Wall Street and a buy from Seeking Alpha analysts. Now, in terms of the yield forward-looking, 0.85%, it does currently trade at a forward P of just over 46 and a market cap sitting around 29 billion. Now, if you have been a shareholder over the last 5 years, you would be up 290%. Bear in mind, it doesn't include dividends reinvested, so if you were reinvesting, this would be slightly higher. So taking a look at their dividend safety, we can see a score of 60, borderline safe. We can touch upon that in our analysis later on. Market cap 29 billion, as we mentioned, and also we'll discuss a 25% increase to their dividend this year. Very strong. Now, in terms of the last recession, well, they didn't pay a dividend, so no comparative data. They have above average growth, -7%, when the S&P brought in -12%, and they did also outperform, although marginally, the S&P -45% return, with the S&P bringing in -55%. 25% increase to the dividend just this year, and over the last 5 years, 27% year on year, so very, very strong, a good dividend growth company, and they have been increasing those dividends for the last 6 years. Now, for those viewers that are new, essentially we always take a look at dividend yield theory. It does state a company is undervalued when the current yield sits above the 5-year average, so you could argue marginal undervaluation / slight reasonable valuation. The same can be said for the forward P. We note it is marginally higher than the 5-year rolling, but when we do compare it to the information technology sector at 24.9, Monolithic does sit much higher, and bear in mind we never look at any of these models in isolation, and we will conclude towards the end. Free cash flow payout, as always, we do draw your attention to the free cash flow. Earnings is susceptible to manipulation by management through accounting. Below 50% if you want to be industry specific for semiconductors. My own blanket rule is 60%. The reason for this is because I believe it is below that, then management have that ability to offer us those double-digit dividend increases we love to see. Now, across the board, it has been pretty inconsistent, not really below the 50% year on year. However, 2023, it was 33%. FY24 expected to be around that level of 51%, so no red flag indicators based on this information. Now, what we like to see with companies we invested is increasing free cash flow year on year. Now, over the longer term, we do see some massive growth, although notably it did just come in the last year, and do bear in mind that FY24 is expected to drop. Nonetheless, over the longer term, it is moving in the right direction. Sales growth, incredible. Typically for companies, we see steady moderate growth of 3 to 7%. Every single year, pretty much double-digit growth to their top line. Although we do want to make you aware their latest year, there was a slowdown down 2%. And we can see when looking at this numerically, they have increased their top line dramatically from 280 million to 1.82 billion. Now, shares outstanding, what we like to see is a reduction year on year, those share buybacks. However, you have to note with this company, they would have diluted your position. Although marginally and they don't have many shares outstanding, it is something just to note to include into your own investment thesis and maybe factor it into your margin of safety. ROIC, return on invested capital, one of my 7 golden dividend metrics. For me, this does give me that faith that management are able to effectively and efficiently allocate their capital. And what we can see, if you want to do above 12% for semiconductors, they have not just been above that for the majority, but increasing nearly every single year. 23% very strong in the more recent FY23 period. Operating margin, very nice to note, above 16%, and they have done that pretty much every year. We see operational efficiencies with their margins increasing, and what I quite like about this company, not only are they increasing their top line, but they're also increasing their margin overall year on year. Free cash flow, very nice, above that 5%. 2023, a very strong year with a 33% free cash flow margin for this company. One of the best, or in fact the best score you can get on a net debt to EBITDA, earnings before the interest, tax, depreciation, amortization, is 0 all across the board and into FY24. The reason for this, it effectively correlates to both dividend safety and balance sheet. So they have an incredibly strong balance sheet. And as we saw, their dividend does look to be safe when we correlate it with their free cash flow payout, which is expected to be around 51% next year. Because what these numbers do signal are the number of years it would take the company to pay off all of their debt net of cash in hand. And even with the reduction to 1.5 for semiconductors, with other companies being 3, it wouldn't even take them 1 day. So very, very strong company, very strong balance sheet. And based on our analysis, that dividend does look to be safe. Now jumping into the valuation, as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do run through every single one of these models, showing you how we get to our numbers. Today's episode, we're going to jump straight in as it is action-packed. The intrinsic value is coming to $696 with a current price of $595. We start off with our margin of safety. 10%. Now we use this and execute on this if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we keep going to this near the current trading price at a 15% margin of safety, which it is a few dollars shy. You are getting an acceptable buy around $592. So we would say for MPWR in today's episode, you're getting a near 15% MOS level. And Wall Street, who we did indicate earlier, who say this company is a buy, giving an upside of 31%, $780, which does indicate that this is definitely a company, if you were looking to add semiconductors in the portfolio, something to consider. And as always, as we do go along these stocks today, do give us your thoughts in the comments below. Are you buying, adding to the watch list, or maybe for whatever reason this one isn't for you? The next semiconductor dividend-paying company we're looking at is NXP Semiconductors, ticker symbol NXPI. Now this one, again similar to the previous company, 2 buys with Wall Street and seeking alpha analysts. It is currently trading again in the midpoint of the 52-week range with a forward yield of 1.89%, a forward P that does look fairly low in comparison to its competitors at 15.66. And over the last year, a fairly strong performance, up 28%. Over the last 5 years, as we can see, up 121%. Now, in terms of the market cap as well, we do see that sit there at 55 billion. So let's take a look. Another similar dividend safety, borderline safe score, market cap 55 billion, a large cap company. Now, the last recession, again, no dividends were paid, but we do see the sales are down negative 39%, significantly lower than the S&P. Now, we are still waiting for a dividend increase, but over the last 5 years, they have increased those dividends by 52% on average year on year, and we can see they have 5 years now of those consecutive increases. Dividend yield theory, then we get that undervaluation signal on the yield, 1.87 versus 1.43 on the 5-year rolling, and we do see the forward P isn't too far off that 5-year average, and it is significantly lower than the information technology sector P at 24.9. In terms of the free cash flow payout for semiconductors, as we mentioned, below 50%. It's been below that every single year that it has started to pay a dividend. 2023 at 42%, FY24 expected to come down to 33%, so we should expect soon a nice double-digit dividend increase. In terms of the free cash flow, well, again, it has been increasing over the longer term, pretty much doubled over the period. There is some inconsistencies with some years of massive growth followed by decreases. Again, you could argue the cyclicality of the industry, but we do know FY24, they are expecting nice growth to their free cash flow, which is always a positive and attractive sign for both investors and potential investors. Now, their top line growth is very inconsistent, as we can see. 2021 to 2022, some very strong numbers, but we see the more recent year just a 1% increase, so it will be interesting to see what their forward guidance says for FY24, but numerically speaking, they have more than doubled their top line over the last 10 years. Now, shares outstanding, bit of an interesting one to discuss. We do know they did increase those shares, so dilute your position from FY15 to FY16. But since then, they have been reducing those shares, doing share buybacks. But unfortunately, if you've been a shareholder since 2014, the net position would be a very small net dilution. Again, something you can incorporate when you do your own due diligence. ROIC, the last 3 years, very strong, but bear in mind they did go through a tough period from 2015 to 2020 where it was low single digits. However, nice to note the consistency over the last 3 years, looking very strong in those healthy double-digit numbers. FY23 coming in at 18%. Margins, again, we do know that tough period. It was, in fact, lower than what we like to see, but over the last 3 years, looking very strong. And in better news, we see the free cash flow margins very, very healthy year on year over the last 10 years. This is a very nice free cash flow machine in the semiconductor industry with around 20% nearly every single year on the margins. In terms of the net debt to EBITDA, what we do know, it does straddle around the 1.5 for the majority of the last 10 years. FY23, FY24 expected to be pretty much the same around that 1.5 level. So incorporating this, with the fact that their free cash flow payout is very low, the dividend does still look to be very safe, in our opinion, in this analysis. In terms of the valuation, and don't forget you can click on the pinned comment below, so you do grab a copy of this model so you can get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list. Margin of safety then, starting off with 10%, it is a buy up to $231. 15% up to 218, and not quite there at 20%, so between a 15 to 20% MOS, in fact more towards the 15, as it does look to be a buy up to $219 if this is the MOS level you are satisfied with as an investor. In terms of Wall Street, well, they see 20% upside just over the next 12 months, $259 as their price target. As we mentioned earlier, some investors will prefer to buy ETFs rather than looking at individual companies. This one does look like 20% over the next 12 months. So let me know your thoughts in the comments below. What sort of upside percentage do you look for stocks when you are looking to invest in individual ones? The next semiconductor that we have to bring is Skyworks Solutions. Now this one is down 8% over the last 12 months, and we can see over the last 5 years a bit of a roller coaster, up 11%. All-time highs do sit around that $200 mark, so it has fallen half of what it was around 2021, 3 years ago. Now it does also currently trade in the mid to lower end of the 52-week range. Again, we have two buy signals, and we can see one of the higher yields in the industry at 2.83%. and a forward P sitting at just below 14. And again, a market cap, we are talking about some very small semiconductors at a 15 billion market capitalization. In terms of looking at the dividend safety, we have a score of 68. It does look to be safe. Again, market cap, it is a large cap company. And in the last recession, similar to the majority of semiconductors, no dividend was paid. However, one of the better ones with above average growth and significantly outperforming the S&P 500. Dividend growth, very nice last summer, nearly 10%, that double digit, which we have seen very often over the last 5 years, with 14% year on year on those dividends if you have been a longer term holder. 9 years as well of those dividend increases, and when we do take a look at dividend yield theory, we do get that undervaluation signal, a very strong one in fact, with the forward P, however, looking more in line with the 5-year average and significantly lower than the technology sector P at just under 25. Free cash flow, well, lots of positives. It has been consistently below 50%, FY23 at 25%, FY24 at 35%. No worries whatsoever, so we can understand why they do have that safe score. And free cash flows has more than tripled over the last 10 years. And even with the drop expected next year, it is still looking like over the longer term, this is a company that is increasing their free cash flow. Sales growth, again, you can see with the smaller companies, there is more of that cyclicality, which does impact them. 2023, negative 13%. 2019, very similar. However, when we do look at it numerically over the longer term, they have essentially more than doubled their top line over the last 10 years. What they've also done, which is nice, on top of those double-digit dividend increases, are those share buybacks that we can see, reducing the shares outstanding from 193 million to 160. So that's an added bonus just to bear in mind on top of all the other positives from this company. ROIC, now above 12%, and although it has been decreasing, it is a trend that we can note from this analysis. 15% in 2023 is still very strong, but something just to keep an eye on, as we don't want this to get any lower than that 12% level. Operating margin, again, very inconsistent, but consistently above the minimums, and FY23 at 24% is still very healthy, and a trend that we are noting with semiconductors as a whole, they do tend to be very strong free cash flow machines. FY23, 34% makes it a very attractive proposition. Now, net debt to EBITDA as well, for the majority of the last 10 years, it wouldn't have even taken them one day to pay off all of their debt net of cash on hand. FY24 expected to be very close to that zero level, so a very strong balance sheet. When you consider this, as well as that free cash flow payout, the dividend does look to be safe. Now, let's get to the valuation, understand what kind of intrinsic value, margin of safety, as well as Wall Street forecasts we are expecting. So an intrinsic value of $134. 10%, it is a buy up to $121. At 15%, up to $114. At 20%, we can see there is some nice margin of safety with this company. At 30%, it isn't quite there yet, so a very solid 25% MOS level for SWKS in today's episode. How about Wall Street? Well, they factor around 20% upside. They have a price target of $117. Again, as we saw at the beginning, they do consider this to be a buy now for the portfolio. We then have Microchip Technology, ticker symbol MCHP. Now, interestingly, we only have one buy rating, although it is from Wall Street. This company in the midpoint of the 52-week range. A nice yield for a semiconductor at 2.2%. A nice forward P at 16.6. And we can see the market cap sitting at $44 billion. Now, over the last 12 months, it is up around 8%. When we look over the last 5 years, it is in a very nice upwards trend of around 71%. Again, factor in if you do reinvest your dividends, that would be slightly higher. How about the dividend safety? Well, 60 borderline safe. As we mentioned, a large cap company and a very nice dividend growth that we can take a look at. In terms of the last recession, well, they did in fact increase their dividend. They had below average growth, but they still outperformed the S&P with their negative 40% return. Very nice to see, not just from a semiconductor, but any company in general. 39% increase to the dividend last year, double digits both over the last 5 and last 20 years. And when we take a look, they have been increasing those dividends for the last 20, indicating they are 5 years away from becoming a dividend aristocrat. Now, when we take a look at dividend yield theory, what we do note here is an undervaluation signal on the yield. However, we can see the forward P is very high in comparison to the 5-year and in fact above the information technology. How about their free cash flow payout? Well, actually, it has been pretty low and decreasing over the last 10 years, but we do want to factor in that FY24 is expected to go higher than the minimums, or in fact the maximum we like to see at 50%. So do bear that in mind at a 66% free cash flow payout ratio. Free cash flow per share, well, very nice increase in fact year on year. They have increased this by 3 times over the period, but we do want to factor in FY24, their free cash flow is looking like it will be dropping in the new year. In terms of sales growth, well, a little bit inconsistent, but overall it isn't bad, as you do see many years of strong double-digit growth. In fact, the last 2 years have been one of their best periods, and when we look at that numerically, we can see more than 4 times growth over the last 10 years. Now, again, we do like to see excess cash return back to shareholders, but in fact, they have diluted your position over the longer term. Marginally, you could argue, but still something just to consider or at least be aware of as a shareholder. ROIC, well, inconsistent, but the last 2 years have been very strong. Over the course of the last 10 years, though, they have gone some periods where they have struggled with these metrics. In terms of the operating margin, well, over the course of the last 10 years, very healthy. FY23, 37%, looking very good. Free cash flow margin, again, something that we just want to consider a general theme with semiconductors. They are very strong free cash flow machines. This is one of the best, as we can see, in the mid to high 30s in the more recent period as well. Net debt to EBITDA, though, whilst it is around that level that we want to see in FY23, we do know it was very high, although it has started to come down, and the expectation is that next year it will go above that significantly. So something to consider, that this, alongside the free cash flow payout in the 60s, may mean that that dividend is safe level and not at that very safe level just yet. In terms of the valuation, so the intrinsic value is the average of these three. Today's episode, it is arriving at $116. Current price, $83, margin of safety at 10%, then a buy up to 104, 15% up to 98, and we do see again another very nice MOS level, not quite there at the 30%, so between a 25 to 30% margin of safety based on our estimates and judgments today. How about the upside? Well, Wall Street consider $98 to be their price target, upside of 18%, again indicating that these are very strong companies, all buy ratings and all upsides around the 18 to 35% that we saw at the beginning of the episode. We then move on to the next one, which is analog devices. Now again, we have 2 out of the 3 buy ratings. It is trading in the mid to upper end of the 52-week range with a yield of just over 2%, a forward P of just over 30, market cap on the larger end of today's episode at 91 billion, and over the last year it is pretty much flat. Over the last 5 years, however, up 65%. In terms of dividend safety, well, we have a safe 63 score, and we can see nice dividend growth in the more recent year. In terms of looking at the recessionary metrics, while they did increase their dividend, they had below average growth, although they did marginally outperform with their negative 48% return. Again, 7% just this year, although over the last 5 years and the last 20 years, we have seen some very nice growth with this company, and similar to other companies, they are only 5 years away from becoming a dividend aristocrat with those 20 years of consecutive increases. In terms of dividend yield theory, then we get a nice sign here of undervaluation, although on the forward P, we do note it is significantly higher than the 22.3 we have seen on average over the last 5 years. And again, the information technology sector P is much lower at 24.9. In terms of the free cash flow payout, again, it does straddle around the 50% for the large part. In terms of FY24, it is expected to increase, although slightly higher, so I wouldn't say there is much to worry about with that dividend so far based on this information. Free cash flow has been increasing, in fact, more than 3 times over the last 10 years. It is expected to marginally drop, though, into FY24. In terms of sales growth, well, again, we note the cyclicality, but on their good years, they are very good, very nice double-digit growth. 2021, 2022, a very strong period, although we do see that very large drop to a 2% increase into FY23. Numerically speaking, though, they have more than 4 times their top line over the last 10 years. And again, similar, it is a fairly common theme that we are noticing with these companies diluting your position over the longer term. Now, ROIC, they have had a few years where it has been pretty decent, as we see. However, you have to go back all the way to 2014 to 2016. Something to keep an eye on. 9% in FY23, not the worst, but we would like to see them go back up to the double digits that we have seen a fair number of years ago. Margins looking very healthy, very consistent across both operating side and free cash flow, so no worries there whatsoever, as well as the last year looking very healthy. And the net debt to EBITDA, 1.06 in FY23, although we do notice it is expected to come up to 1.5 in FY24. Something just to keep an eye on year when those annual reports do come out. And do let us know if any of these stocks in particular are ones that you would like us to a much deeper dive on. Now let's get to the valuation. Don't forget you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list by clicking on the pinned comment below. Margin of safety at 10%, then a buy up to $205, at 5% up to $194, at 20% it isn't quite there yet. So for today's episode of ADI Analog Devices, we do see a 15 to 20% MOS level. In terms of Wall Street and their forecast, well, we can see they have a price target of $216 and a buy rating with upside of 16%. As always though, do let us know your thoughts in the comments below. Are any of these ones that you are looking to buy, maybe on the watch list for a future date when they do come to a reasonable price, depending on your own margin of safety and acceptable buy price? As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. As always, we'll see you on the next one. Drop us your thoughts below and take care for now.